it's not that dangerous because they see their family get it and friends and whatever, and people seem fine. Or it just gets swept under the rug, and maybe they don't.
We run.
Yep, you get to go.
Okie doke. Cool. Yeah. No, it is crazy. I mean, y'all are probably too young to remember, but Tiananmen Square, I mean,
yeah,
that felt like that may have been kind of the start of something real. And even though the Communist Party remained in power, they have been more responsive to people than like in my lifetime since then. So
yeah, it's hard for me to tell. Like, even with Tiananmen, people thought Deng Xiaoping was going to be this whatever really Western democracy capitalism guy, and then he sent tanks in to just absolutely demolish people.
Yeah.
So I think if the party is pushed too far, they'll just take people's heads off and show who's boss and move on from there.
Well, the thing I don't understand is the policy in China has always been, we have a lot of resources in people, so we'll go ahead and squander our resources somewhat. They build a building and 25 people die building it. They don't really care, right?
Yeah.
So it's really weird to me that they have this zero tolerance COVID policy, particularly when they were limiting births not too long ago.
I think it's a form of control, right?
I guess so. Yeah.
And just showing how much you need the government.
I wonder if it's also they have this real estate sector that's clearly bloated. That's clearly, the stability of society is riding on the value of their homes not going down. So they don't want to raise interest rates because that might force down the property sector in China. How do you slow down the economy from overheating and causing too much inflation without raising interest rates? You make people not do stuff. So maybe they're just locking people down to slow down the economy without having to raise interest rates.
Daughter Sarah has one take on it, and she's my 17-year-old that will run the world one day. We're not sure for good or for evil, but she's going to run it. Her take is China is defensive about COVID, i.e. it probably leaked as an accident out of a lab, and to cover up, they're taking COVID very seriously, zero policy, etc. That if they didn't really care, they'd be, whatever. But the fact they're taking it so seriously looks like, okay, maybe they weren't responsible for it.
We totally didn't do this. Look at us.
Look at us. So, I don't know. Yeah. But anyway, it's interesting.
Yeah.
Because, you start talking about China and growth trajectories from here to here really, really matter,
Not only for China, but for the whole world.
Yeah, no, that's exactly right.
Just today, oil prices were down like $5 and then back up, $5 just based on the whims of China and whether or not they're going to use a bunch of oil.
Yeah, no, exactly.
I fired from Cain, now we ain't got no shame, so we started a project, guys, it's a job.
Hey everybody, welcome to Chuck Yates Needs a Job, the podcast. My guests today are the Montrose Lane founders. And do y'all have other titles? Or is it just founders? Is there a managing partner in there or something?
We're both managing partners, so whatever. Founders.
We were literally one glass of wine away from me at Kane sending an email saying we're all freaking associates from this moment going forward, because I was y'all are a small enough shop that y'all don't get this, but boy, we used to have people get so upset about their titles just at any moment, and I was like, I don't even know what your title is. Why are you griping about it? Jeremy Arendt and Ryan Gurney, though, are here. So glad to have you guys.
Montrose Lane.
Yeah, associates at Montrose Lane. So real quick, because my mom listens to the podcast, one of you real quick, give the Montrose Lane commercial. Who are y'all? What do y'all do? Just so mom will be caught up.
Yeah, I'm happy to do that. So we're a private equity slash venture capital fund. We raise funds from investors, so institutions, wealthy individuals, family offices, and those types. And then we take those funds and invest those into technology companies that are selling into the broader energy industry. And the types of things that we invest in have to hit various criteria. But really, what we're looking for are companies that make energy, one, more affordable, two, safer for the people that work in energy, and three, better for the environment. And so that's our goal. We've invested in 10 companies to date across two funds. Right now, we're at a point where we are helping to hopefully help those companies grow, invest additional capital into those companies as needed, and then eventually go out and try to raise a third fund to expand on what we've already done.
And note of full disclosure, Mom, this is the venture capital fund that I'm on the advisory board of. And so we'll say that. I'm not sure what advisory board means other than maybe like older brother, Uncle Chuck, maybe.
Hang out sometimes.
Yeah, hang out sometimes. But
And I would just add on to Jeremy. So the three criteria that we typically have when we invest in a company is, one, software is a primary product or service, so we're not investing in anything too hardware heavy. Two, customers in the energy space. We've got a broad definition of energy. That can include oil and gas, can include other forms of energy, et cetera. We think all those forms of energy are relevant, will grow, and be a big part of the overall supply chain go forward. And then last is post revenues. These are companies that have some scale, and then when we invest, that capital goes to help fuel growth after that company has found product market fit.
so what years were Fund 1 and Fund 2 raised in?
Yeah, so we raised Fund 1 in 2017 and 2018. And then we raised Fund 2 in 2019 and then closed in 2020.
And how many companies, because you've had a liquidation event, right? You
Correct.
sold Mineral Soft and, knock on wood, did really well with that.
Yep.
How many companies you got? So 9?
So we've invested in 10 total,
Okay.
6 in each fund, and there's 2 crossovers. So that's kind of the -2 there. And then we've got 8 active companies today. As you mentioned, we sold one, and then we had one that we ended up closing.
Gotcha. So because what I get questioned a lot from with people talking about y'all, I'll just kind of throw this out there in no random order, is one, how'd the portfolio do through COVID? And did you guys notice kind of any trends during COVID, maybe that are different than before COVID and when you were originally raising the funds?
Yeah, I would say, look, in short, 2020 and COVID was challenging. That said, I was pleased in terms of how our portfolio performed. When I say it was challenging, most of our companies have customers that are upstream oil and gas operators. In 2020, when oil prices go negative, there's a state of shock in those upstream producers. You could have the absolute best technology that delivers a ton of value, et cetera, but the issue is that state of shock led to kind of chaos in those organizations where your internal champion didn't know if he or she was going to have a job, let alone the ability to invest in a technology suite and change a legacy process. So that state of shock and that state of confusion and the state of just kind of disarray made it challenging for our companies to sell new licenses to new customers. In contrast, what we found with our existing customers is we didn't lose customers, broadly speaking, maybe with the exception of some M&A events. But what we found is a number of heads were removed from upstream operators, but then we found our customers leaning more into technology because that technology allowed them to be more efficient with fewer heads. So we were pleased with that. But look, when we underwrote these investments at time zero, we anticipated growth year after year, not a flat, effectively year in between.
Because that was the theory I've had that I talked about a lot on the podcast was, I kind of lay out this thesis that energy's always been a lottery ticket business, right? At the end of the day, you could get really rich through no fault of your own. The Saudis embargo, oil prices triple, lo and behold, you're rich. You can shoot 3D seismic, and all of a sudden there's a big, huge structure no one's ever seen before. You drill it, and you got a 10 million barrel, field, whatever the case may be. Just a lot of things, like I say, lottery ticket that can make you rich. And so we as an industry spend a lot of money doing getting ourselves more lottery tickets, if you will. And then the nickel and dime type stuff that other businesses run and squeeze efficiencies out of, like Amazon or whatever. We've just been horrific as a business doing that because it didn't give us another lottery ticket. And I think a lot of the technology stuff that you guys invest in are about nickels and dimes in terms of running more efficient type businesses. And so it's interesting to hear you say that customers didn't really leave you during that, because I feel like there was pretty big seismic shift in terms of, no pun intended, in terms of people going, okay, nickel and dimes matter now that oil's at minus 37. We're going to really have to watch that.
Yeah, I think it matters a lot when you have a thin positive margin. I think what happened in 2020, and then I think the sentiment carried over into 21, was at our customer base of we have a broad customer base, but I'm just talking about the oil and gas companies, because that industry was just thrown for a huge loop as a result of COVID. At those companies, you didn't have thin margins, you had negative margins. You were losing money, people were being fired. The general popular sentiment was that oil and gas was going away. And so the actual people making purchasing decisions had a lot of volatility in their lives, in their professional lives. And they weren't in the mood to go sign a contract to go spend, thousands, hundreds of thousands, millions of dollars on a technology, because that could be a career limiting decision. And in 2020 and 2021 could have put you on the block to get fired, along with a lot of other people getting fired in oil and gas. So you had that factor. And then you had the just broader, I think, social sentiment of, as I mentioned, that oil and gas is going away. That BP came out and said we're at peak oil demand. And when a big oil producer comes out and says that, much less a bunch of governments and other groups,
Kathy Wood,
yeah, you can't help but to at least wonder. And I think a lot of people wondered, including people in the oil and gas industry. And you saw a lot of investment shift from, all right, well, we're going to go explore for new fields. We're going to go invest in drilling new wells. I mean, of course, you're not going to do that when the very essence of the industry is in question. And so I think what happened with a lot of our customer base was that they said, hey, look, we got to spend our time focused on other things. And we got to spend our time wondering if we're going to have a job. I think what has changed in sort of, back end of 21 and through to today is a real firming up of views, maybe not in the world, but certainly in the oil and gas industry, that, all right, feels very healthy. I'm going to have a job. I still have the capital markets and, maybe society as a whole telling me that I need to be very thoughtful about my capital spend and be very thoughtful about drilling new wells. So I need to be hyper efficient in my existing operations. And meanwhile, as Ryan mentioned, a lot of people in my industry lost their jobs, and we're not exactly hustling to go rehire those people in a lot of circumstances. And so we have to invest more in technology to allow for the operations of these companies in an efficient manner. And so I think that has been a big tailwind for our companies, is the efficiency play. Another big tailwind has been the push towards limiting greenhouse gas emissions, broadly labeled, as ESG. And that has been a huge tailwind for our companies, primarily because, look, like, the best way you could reduce greenhouse gas emissions, if that is your goal, is to look at existing industry that is producing a lot of greenhouse gas emissions and make that industry more efficient, reduce the emissions that industry is producing. And that in large part is what our companies and the types of companies that we invest in go out there and do. So that has been a second tailwind that's really started to take hold, through 21 and through today.
And I hate this for the humanity side of it, so I don't want to sound like I'm a cheerleader for it in any way, shape, or form, and being a victim of the acts, if you will, during that period. It also feels like the industry just got a lot younger too. That a lot of the people that were let go were the older, higher paid type folks and younger people are just more adept, more used to using technology than older folks.
I think that's exactly right. And there had been a distribution of ages because not a lot of people came into the industry in the prior downturn in the 80s. So as those people leave the industry, they're being replaced by people that are in their 30s to 40s that are just in general more receptive to technology, which has been a good trend.
And I think there's some spillover from other technologies, right? The longer you use one of our portfolio companies in your operations, the more you trust that another technology that solves a different problem might actually work. So when we first came into this, it was very little use of digital technology among our customer base in the types of things that we were investing in, like cloud-based specific, specific either operational or back office or, field management or whatever goals, just people weren't using digital technology to do that. And so I think you have to break through that a little bit and say, all right, look, this part has worked out really well for you. Let's see if we can also help out in this other part of the business.
Because I think you're getting to a point too where if people can't do something on their iPhone, they actually have a problem. Meaning it's, you throw paper, you throw Excel on the computer in front of people, and it's just, hey, there's got to be. So I would think there's actually pull now happening of why don't we have an app that solves this problem?
Yeah, I think the phones broadly have, I think, changed a lot of people's perspectives on technology and how much that can help you. This is a total aside, but I find it fascinating. Like we as people have kind of made this trade of I'm going to give up all kinds of privacy for whatever privacy is worth to you, to have this phone that's on me, at least for me, literally 24/7. Like I sleep next to my phone. I know that my phone is logging everything I'm saying and, whether that goes and influences the ads that are on my phone or the ads I get in my email, or that, say I'm a super criminal and the NSA is, tapping into what I'm saying. Somewhere in between those, that's always happening. And generally I'm okay with that because this thing makes me so efficient. I can just do so many things from anywhere in the world. I save so much time in my day-to-day life than I would without this thing, that it's unthinkable to get rid of it. And we think that as technology progresses, as business just mindsets and processes progress, that you won't be able to run an energy company or really any company without a heavy investment in digital technology. Because similar to how it makes my individual life a lot more efficient, saves me a lot of time so I can go do other things. I think from a business standpoint, every day that goes by, we're going to get a little bit more efficient by leveraging those technologies. And that's going to be very good for really everyone in the industry and the customers of our industry.
Yeah, I love the joke about how you're walking through your house talking to Alexa and, whatever, and you go, oh my God, Alexa's listening to me, and Siri's like, yeah, she's a bitch. Just like, because there's no question that they are listening. But I think the other thing that comes into play, or at least what I'm seeing, and I'll say this as a statement, but just get y'all's take on it too, is, I've talked, because I hear all the time, people reaching out on Twitter or LinkedIn, whatever, hey, when's capital going to come back into the industry, and talking upstream. And I always say it's when a CIO can become a former CIO for not having energy exposure.
Yeah.
And, some way, shape, or form, a CIO is graded by the S&P 500. There's some take or twist or formula based on it, but it all comes back to basically the S&P 500. And when you're 5%, 6%, you can actually still avoid energy and hit your hurdles or be close enough that you're not going to be a former CIO. And so I think one of the things that's becoming more apparent to people is my capital to go grow my business is actually my cash flow. And I think you hear people talking about nickels and dimes and saving it because that's my future. CapEx is coming out of that.
Yeah, I think that's exactly right. I think cash flow is going to be a big part of it. I also think allowing investors, giving investors the ammo to feel good about their investment in traditional oil and gas, I think will be important. We are being a good steward, and we can show it based on these metrics, and this is how we've trended, and this is what we've done to improve those trends. I think if you can generate cash flow and show that you're a good steward, I think that's where the capital will go. And I agree with you; it's only a matter of time. Candidly, we're beginning to see it in our business, where I'd say 2017, not a lot of capital. 18, 19, things increased. 2021, nada. Back half of 22, we've begun to see some generalists reach out to us saying, "Hey, can you tell us about your portfolio? What's going on here?" Because I think they do look at the broad S&P and say, "What is outperforming? Energy. Okay, maybe this is a space we should look at in the context of software investment." So early innings, but I think it is only a matter of time.
Yeah, I think you'll have a re-rate of capital back into the industry. I think it'll take longer than we think because, and just to clarify, CIO, you mean Chief Investment Officer, not Chief Information Officer. But it, I think that person has to miss for many quarters. I don't think it's a couple of quarters or even a year. I think it's like 8 quarters in a row of the energy segment of the S&P outperforming the other segments, and it's been doing that so far this year. But I think that it'll take more time before you see a lot of the institutional folks come back in and say, okay, we want to go fund drilling programs in the oil and gas industry. But I do think that inevitably happens because the dearth of capital is, as long as capital isn't coming in, those returns are going to be really high. And so it's almost a force or a fact of nature that capital will be forced back in because the returns are going to be high. So I think that'll happen. And then also with higher cost of capital, I mean, the Fed funds rate is now 4%. In a couple of weeks, it'll probably be something higher than that. And a couple of months after that, even higher than that. So discount rates for everything, any capital asset are going up, which means the values of any future cash flows are going down. And so I think we'll also have a big, reallocation away from future cash flows, which might be, hey, I got a great thing that in 2040 is going to be really valuable and start putting off a lot of cash. In 2020 and 2021, when we had a 0% Fed funds rate, you could make that make sense. You can make that really valuable. And I think that's why you saw a lot of those companies trade for very high values, both publicly and privately. But now with higher cost of capital, you need those cash flows today. And the cash flow today is worth a lot more than the cash flow tomorrow. And so I think industries like oil and gas that are very cash flow positive today, and we see that with each earnings report that comes out from particularly the E&P companies, those are going to end up attracting more capital on a relative basis because I want a quick return on my capital because my capital is very expensive. So I think for those two reasons that we will have more capital come into energy and specifically into near-term cash flow energy. But I continue to think it'll be a little bit because you've also had a lot of investors out there essentially either privately or publicly swear off traditional energy. And it's hard to then circle back and say, all right, well, just kidding, never mind. I think that'll come. It'll take some time. And I think to Ryan's point, we got to make that message easy. And I think our investments do make that message easy for the reasons I talked about. If we're going to be using all this energy, gosh, we sure do want it to be affordable, safe for the people that work in it, and as good for the environment as it possibly can be. And I think through efficiency and transparency, we can help drive a lot of that.
Do you think the war in Ukraine has kind of changed that in terms of, let's call it, maybe acceptance is too strong a word, but at least somewhat mitigating the anti-hydrocarbon bans that have happened? Because I think, at least what I've heard from one of the large bulge bracket investment banks is it's actually on their ESG list of getting natural gas to Europe. i.e., that's a positive now. Does that help? Or
Yeah, look, I mean, I think the EU is now referring to natural gas as a a green energy source, and so I think I look, saying that helps is kind of it feels macabre because
yeah, no,
like
that's fair.
we don't want certainly don't want people dying to help uh, something or the view of that. I think where it has changed perspective, I guess, is around security. Um, I think in 2020 and 2021, there was a view that energy is almost limitless. That oil, gas, coal are always going to be really cheap, and always going to be there as a backup plan. And so we should be investing a lot of money and a lot of time, a lot of effort, a lot of brain power into what comes next. And I think what Russia rolling tanks into Ukraine showed us is that energy is more than just turning on the light switch. Energy is security. And so much of our lives revolve around the availability and the affordability of energy, that we need to take that supply chain very seriously and make sure that we have, not only access to the supply, but the means of production of that supply. So I think that has started to work its way in a little bit, the energy security argument. But probably I still think it just comes down to more than anything, just economics. And I think for opinions to really change, you're going to have to see people look up and they say, my life is worse because we had bad energy policy. And I think we're a ways away from that before there's a broad recognition of that. It's easy for us to sit here and talk about it because we have a generally more exposure to the energy industry, more experience in the energy industry. But I think for the average person to say, all right, maybe that was a mistake. Maybe we should have spent more time, securing our own production around fossil fuels. I think that's still a ways away.
Because, I mean, Ryan, there's no doubt the transition is happening. I mean, and it's not for all the libertarian in me wanting to say it's big bad government making us do that. It's not. It's consumers have chosen this, companies have chosen this, private entities have chosen this. And I mean, we are going to see a transition. We're going to see a lot more in the way of renewables, et cetera. And so, how do you guys see that, one, kind of playing out, two, seeing opportunities in that, et cetera?
Yeah, I think what I struggle with is I agree with you. I think transition is happening. I think we should have as many sources of energy as we possibly can. That's a great thing for all parties, and in theory, should lower the cost of energy for all parties. What I struggle with is the vilification of, should say, oil and gas in that process. Like, it doesn't need to be oil and gas is terrible. All these other things are gumdrops and fairyland. It's like, okay, let's just capitalize both and grow both as the overall energy demand grows. So I think that's the nuance that we get hung up on, because it doesn't seem fair to the traditional energy side of the equation. And then it results in a lot of capital going to the transition side, and ultimately bidding down potential returns, because that is a smaller market today. So look, I agree. I think transition is happening. I think we'll have more and more forms and sources of energy, but I feel like it's gone too far in terms of vilifying what feeds us today.
Yeah. So two things on that. One, from our investment thesis standpoint, we want to invest in technologies that serve A, oil and gas, B, every other part of the energy spectrum, and really any sort of industry around the world. That's the ultimate goal, right? We have a competitive edge in going and investing in companies that sell into the energy space. And so that's where we spend our time. But ultimately, we want our companies to sell to whoever, governments, other industry, consumers, whoever wants to buy a product or a version of a product that our companies are making. So we're pretty indifferent to what the energy mix is from a company investment thesis standpoint. We just want to invest in the best companies that provide the best services, create more, make energy more affordable, safer, and better for the environment, no matter that source of energy. as it relates to the energy transition, I think it came on really strong and fast. It's just, my personal views because of cheap capital. As I mentioned, like when you have a 0% Fed funds rate, you have a really low discount rate. You got the 10-year Treasury trading near zero. You had government bonds in Europe trading at negative returns. So capital is essentially close to free. And so if you have a great technology that if this really hits, it could be worth a lot, then that even today is worth a lot. I think what is a huge threat to energy transition, at least for for lack of a better word, the fringier, further out cash flow opportunities, I think interest rates are a huge threat to that. And I think that will slow down, maybe not today, maybe not next year, but it will eventually slow down the capital flows into that space, which I think will be a big challenge for the energy transition space. I don't think that's a challenge for like wind and solar, which is already out there, but I think it is a challenge for, say, like, building out a whole hydrogen ecosystem and infrastructure around all that. Another aspect of that is I used to work at TPH, and Dan Pickering always used to say, nobody should ever say this time is different. And this does look, it's like an exaggerated version of the first clean tech wave that was in the 2000s, right? A lot less capital went into that. I think there was a lot less belief in that. And the argument that time around was more around independence from Middle East fossil fuels than it was around saving the environment, reducing climate change, et cetera. So you have some differences, but at the end of the day, you have some very similar things. You had very low interest rates coming out of the dot-com bust mixed with 9/11. And then you saw interest rates start to ramp back up in 06, 07, 08, and you saw the collapse of that clean tech wave. This looks pretty similar in that regard, right? I mean, you've had very, very low interest rates, very low cost of capital, and now that's ramping up very, very quickly. So we'll see if it can survive. But my guess is that the quantum of capital and certainly the pricing of that capital will change dramatically, which will change the dynamic of what people believe has value.
So one kind of funny story to that point, Jim Wazell, who is one of my dad's best friends from high school, was president of Houston Natural Gas when it merged with Internorth to become Enron. And as he likes to say, I'm a dirt under the fingernails type guy. Ken Lay liked his MBA types, and so I was gently shown the door and all. But so back when I was at Stevens in the late 90s, early 2000s, I became a power technology guy because oil was at $8 a barrel and nothing was happening. So flywheels, fuel cell batteries, all that sort of stuff. I was spending a lot of time there. And Jim and I would go eat lunch, and he was so well versed in all this stuff that I was like, this is amazing that you're keeping up. And his story was always, oh, Chuck, we've been doing that. We did it in the 60s. Yeah. We did it in the 70s. We did it in the 80s. These technologies aren't really that new. It seems like they pop up every 10 to 12 years, and we refine them and spend more capital on them for various sorts of reasons. So I kind of always found that story pretty funny that he knew all about that stuff. The second thing that I think is really important, and I'll probably close with asking you guys these questions. This has kind of been my question of the year on the podcast is, if I made you energy czar and you could put one policy in place, what is that policy? We'll get to that. But if I ask that of myself, I think the key to any of this transition is, if we look back, we've spent, I forget what Curry at Goldman said, $4 trillion on this, and we've gone from 82% of our electricity being generated by hydrocarbons to 81%. So in effect, we've only really had addition. We haven't had transition, if you will. But to be able to transition and to not spend, let's call it $150 trillion and maybe only spend $25 trillion or whatever the math is, I think one of the things you have to appreciate is the technologies that win out are usually the ones that are incremental to the existing energy infrastructure that we have, because you're always competing with the marginal barrel or the marginal MCF coming off that. And so, yeah, if we were starting an energy system today, would we use hydrogen? Maybe so, but we're not. And we've got pipes everywhere that do this and that. And so I think that's one of the things that I think's really important and deserves a thoughtful conversation as opposed to a bunch of demagoguing, because at the end of the day, that's going to happen. And I think that's where you guys are going to be important, is that stuff's got to talk to each other, you know?
Okay, I totally agree. The grid is only getting increasingly complex, and the energy supply chain is getting increasingly complex. So how do you make sense of that, and how do you optimize that system? I think software can do it a lot better than people can.
And it's also like I heard that same Curry, however he pronounces it, that Goldman guy's podcast. And what struck me is I wonder whatever statistic he's looking at for the 82% to 81%, what if you were to lump in biomass with hydrocarbons? Because, what is biomass but like a modern coal? You just haven't given it time to age. You're just burning a tree instead of burning an old tree.
It's fresh wine,
Yeah,
not aged wine.
Yeah, you just have to chop down the tree versus dig it up from underground. But I bet if you'd lumped in biomass, which is generally considered a green fuel, oddly, that it actually, like, probably on a percentage basis, hydrocarbons have gone up. So I tend to agree with you. Everything's going to compete on the margin. No, whatever measure BTUs or whatever measure of energy or heat you want to measure it on, you're going to end up competing there. And different energy forms are better for different uses. Like flying an airplane is pretty hard to do with electricity. But ultimately, that all competes, and that's a really good thing, because it allows us as a society to try out different things, see what is competitive, see what's not competitive, and then spend more time, money, effort, etc., going after the things that are best for humanity.
I think the really hard thing sitting in y'all's seat, and again, I'll say this as a statement, and you guys both opine on this. I think the hard thing for you guys is looking at this wave that's going to happen, and it is happening, transition. I mean, we're just going to throw a lot of money at it. It really comes down to, you've got to be able to be alpha pickers. I mean, you've really got to get in there and figure out what's going to win and what's not going to win, or what's not going to win, because at the end of the day, with that much money being thrown at things, things will continue to go up in value, but at the same time, it'll stop at some point. We've seen that with every bubble that's ever happened, starting with the tulips, with the internet, with the trains in England in the 1800s. And so I think that's going to be the big challenge for you guys sitting there sorting through that stuff, is just, okay, what is actually going to be a winner versus what is just getting caught up in this tide?
Yeah, 100% agree. And, look, I think that's, through all this, that's a lot of the reason that we have stayed the course, as it were, on all forms of energy, not just new energy or alternatives. It would be much easier for us to just say, hey, we're never financing another company that goes and sells into the oil and gas space. And so you can, dear whatever institutional investors, you can invest in us with a clean conscience and so forth. But, I just don't think that's good for humanity. But B, I think that we can differentiate ourselves by saying, look, we're going to look at the entire energy spectrum. We're going to look at, how are these companies making that energy spectrum better for the end consumer and for that industry itself. And then we can compare, hey, what is the market size? What is the pricing? Where can I get a, for lack of a better phrase, better deal in that, and compare across that. So we think that is very, very important, because otherwise you're going to find yourself just investing in whatever the current wave is, because you've limited yourself to what you will go out there and do. So for us, investing across that energy spectrum is very, very important, and helping that entire energy spectrum is very, very important because they all will compete and they'll all hopefully get a little bit better every day.
Give me something that you know today about investing in companies that you didn't in 2017 when you started this.
Jeez, it's a long list.
Yeah, I was about to say we could do a whole series of the podcast on that.
Yeah. Look, it's a great question. I would say a couple things. One, I'll state the obvious, then I'll give some detail. But at the end of the day, it's all about people that you invest in. It's the classic saying of an A+ team with a C product is going to be a good outcome. A C team with an A+ product is going to be a terrible outcome. And that's what we've seen, time and time again. It's all about the people and putting the appropriate and competent leaders in place.
Have you figured out how to get better judging people over time? And I'll even go first on this is what I figured out is that my gut from early meetings was generally right, and I just needed to start listening to it more and more. And I had 100%. to be willing to just walk away.
Yeah, and I think what happens is I couldn't agree more, because what happens is you might not be certain about the person, but you get excited about the opportunity and the market. And maybe with some tweaks, it'll be okay.
Yeah.
And then you realize after you get married to that person, I shouldn't say it only gets worse, but kind of does. Like those things that you were concerned about only become bigger and bigger and more of an issue. So totally agree. And I think trusting your gut is critical.
Ken Hirsch has a great line: "Yellow lights rarely go green."
So true.
Yeah. No, it rarely gets better over time.
Especially with people. Like if your gut is that this is a weird technology or a weird market or something, I think you can find enough evidence with further research and whatever to convince yourself that, my initial instinct was wrong on that. Now I believe that this is a big enough market or what have you. With people are just so complex that there really is no more investigating. You can talk to everyone they've ever known, and you're still, I think, relying on that gut feeling. And to answer your question, I wish that we would have spent or given more credence to that initial out of the gate gut feeling of this is or is not the right person to run this company. Because that is where I think we have probably made the most mistakes.
Yeah. And I would say, just to be clear, I think now where we sit, we're very pleased with our management teams. Yeah. And I think we're in a good spot with some really great leaders that are doing great things. But it's definitely been a journey along the way and major learnings for us.
Yeah. No, it's always in hindsight, you sit there, and when you're being intellectually honest with yourself, you're like, man, I saw that in the first meeting. The guy or the gal said this, and I'm like, that didn't make any sense or whatever. So
or it's just a feeling.
Yeah.
But yeah, I think that is by far the biggest from my seat.
Yeah. So how you guys operate? Do y'all ever fight? Because I've never seen y'all fight.
Only physically.
Just like Digital Wildcatters, we have an octagon. I would say, and look, that's also been a journey for us. We had never worked together, and we started, the company together and learned how to operate together. I would say, Jeremy and I were and remain great friends, kind of throughout all this, and that is one thing that has remained, very much consistent. We disagree all the time, like all the time, but not in a bad way. It's in a healthy way, and it's a way where we both respect one another and we challenge each other and we push, pull, et cetera. And I think we end up in a better outcome because of that. And I would say, no plans for this, but if I were to ever do something again in the future, you don't want somebody that thinks the exact same way as you. I think that is not a good recipe for success. You want somebody that is kind of truly that yin yang, which I think Jeremy and I have been able to accomplish.
100% agree.
I mean, Mike Hines, my former business partner at Kane, greatest guy on the planet. I mean, really is. Like my brother, to this day and all. But I think one of the issues we had is we were probably too much alike in terms of things. Because when you look at the great kind of private equity firms out there that have grown up, they always have people with complementary skills, and they usually talk about the outside person and the inside person. The inside person is, detailed, big on processes, etc. Outside tells a great story. The fundraiser probably couldn't identify a good investment opportunity if you spotted them, something. But I think that's really well put. And you guys have a great built-in curmudgeon is maybe what we'll call him, but we'll say that with love with Mark Mills.
Yeah.
Because Mark's a great resource.
Yeah, I think he's a great skeptic, right? Mark,
Much nicer than curmudgeon. Sorry, Mark. I just wanted to call you a curmudgeon.
And look, I think that is extremely valuable when you're investing in technology companies, because technology by its very nature is complex. It's new. And so I think you have to have a skeptical eye towards, is this real? If it is real, how big could it be, et cetera. And Mark is very good at that.
So what are investors saying these days in terms of energy, investing in private equity, all of the above?
Yeah, I would say at the highest level, and we're not actively fundraising at the moment, so we don't have kind of a 100% pulse on things. But what we have heard is it remains challenged from an allocation perspective. And I think what we've seen of late is the general view that, okay, public marks have come down, private marks have not come down at the same rate. So now private appears to be over-allocated. So as you think about allocating to private equity, venture capital, et cetera, it feels like it's a higher bar because those allocations are out of whack. I think that's the short-term headwind for any private allocation. I think that ultimately trues up. And then after that, I would say we have seen, it kind of goes back to the generalist investor looking at our portfolio, from an acquirer or investor perspective. We are seeing more folks say, okay, turns out energy's is here to stay, including oil and gas. What are some interesting ways that we can get exposure to this? And we've had some productive conversations along that. So kind of goes back to, it feels like it's thawing, but still early innings with a short-term headwind of kind of the allocation denominator effect.
Yeah, I agree. I think a lot of the, like an individual investor is just going to speak his or her mind, and, he's speaking for him or herself. The institutional folks are speaking for a whole institution. And what we hear a lot is, hey, I think there's a lot of opportunity in, traditional energy. What do you guys think about that? And then we ask, are you, allocating more money there? Is that a place you're investing? Like, oh, no, I can never get that through the investment committee. But I think there is the early innings of all right, I see the opportunity here. And that, to your point, is then a few quarters away from, all right, I've missed the last few quarters because I'm not allocated enough to this. So I need to allocate more to it.
Because I think, just to add on to what you said, Ryan, is so private marks haven't come down as much. That's typical GPs not marking down their portfolio probably as quickly as they should have. But actually the energy portfolio has gone up. So you feel over allocated to private, and to some degree, institutions feel over allocated to energy because the energy has performed well. And there's probably more backing up the marks up in energy. And so it is some wood to chop there. But then, at the end of the day, if you ask Ken Hirsch back in 1998, raising, NGP3, he'd say, yeah, it's really hard. It's always been hard.
Raising funds is challenging, especially private funds that are locked up for 10 years.
Yeah.
That's a real commitment.
Yeah. And I think the other thing you guys brought up that's important for folks to understand, because I don't think a lot of people do, is a CIO, a chief investment officer at an institution, creates a portfolio mix. And their whole goal is not to make money on every investment they make, because if they do that, they probably screwed up. Even though that would be a good outcome, the process would have been bad, right? And they've run the scenario where oil goes to minus 37. Well, that means cheap gasoline and the Amazon trucks are going to be flooding everywhere. So I make sure I own some Amazon too. I always joke that it's concentration that makes you rich. It's diversification that keeps you there.
Mm-hmm.
And so I think that's kind of an important thing that you brought up is this portfolio effect. And, I'll get some pushback on Twitter or something where somebody will say, oh, but you did a dumb deal or whatever. And it's like, well, my clients were paying me for energy exposure. Well, you should make money on every deal. And I go, do you want to make money on life insurance? I mean, that's something you want to lose money on, because you hope to live to be 85 or 90 or whatever it is. So yeah, it's a different way to look at it, an individual investor versus actually an institution.
Yeah, absolutely.
Yeah, I totally agree. And that affects our psyches a little bit because, look, our big thing is we want to go invest in the things that we told our LPs we were going to go invest in. If we told you we were going to go invest in energy technology and then we went and, bought a commercial real estate building, I would feel pretty bad about that. But look, we want to go make good investments into good companies that are doing exactly what we said we were going to do. And you as an LP have decided you want exposure to that. I think where you get into trouble or into a difficult situation with your LPs as a GP is when you stray from that and you start doing things that you said you wouldn't do, and that's something we're very focused on. So even times when there are good days when we feel like we've made our LPs money, there are not good days which are very challenging when we feel like we have lost our LPs money. But through that, as long as you're going and investing in the things you said you were going to invest in, giving exposure that you said you're going to give, and then you can go to sleep reasonably well at night.
Half your job is to make money. The other half is not to look stupid. And style drift is the quickest way to look stupid. Because that's question number one. What do you guys know about a real estate building? You know? And so, all right, let's close this down. I told y'all I was going to ask you this question. I'll let either one of you go first, but I'm going to make you energy czar of the whole wide world. You get to put in place one policy, law, edict, whatever you want to call that. Lay it on me.
I would remove all subsidies, and that includes any tax advantages. So just make the market free across the energy spectrum.
Interesting. That's kind of David Ramsden Wood's take, is at the end of the day, let's free up all the subsidies, maybe even add some tweaks to deal with reliability type stuff. Okay, solar, wind, you got to be able to provide electricity for 48 straight hours to the grid, or you pay a penalty or something. So
I think you just get rid of the subsidies and that gets taken care of, because the people, look, I mean, you're XYZ governor of a state, and you're not going to stay governor very long if the power's shutting off every other day. So I think that, politics on the market will take care of the reliability part. I think the subsidies create unreliability because you get weird outcomes. When you subsidize things, you get weird outcomes. And those weird outcomes lead to a lack of reliability.
Gotcha. So energy libertarian, we got it here. All right,
honestly,
Mr. Czar.
it's not. I was honestly going to say the same thing, which doesn't seem like we think differently and challenge one another. But no, I tend to agree and just let the best man win as it relates to energy source, and I think nuclear would be a big part of that. And maybe the tweak is remove subsidies and significant regulations and restrictions around things like nuclear. Obviously within reason, but I think with that, I think nuclear becomes a bigger part. I think the general cost of energy comes down, and I think security increases.
The one thing playing Secretary of Energy within y'all's administration that I could actually be talked into, and I get the slippery slope argument, and that's ultimately why this may wind up being a bad idea. I could actually live with a carbon tax. I mean, because hydrocarbon pollution, even the most ardent supporter of the energy business would acknowledge driving behind a car that's blasting some smoke at you is pollution. So I could actually live in the framework of let's get rid of all subsidies. Maybe we put some reliability type constraints on power sources, or maybe not. Maybe that's just mandated by that. I could also live with a carbon tax of some sort, just because there is a cost to that.
I think broadly,
Defining that cost would be tough, but
broadly, people want clean air. People want less emissions. It wasn't by government edict or regulation that people started using a lot more natural gas when it became cheaper instead of coal. It was just that, well, natural gas is now the same price as coal, and natural gas is cleaner, and that's kind of nice. So we're just going to use that. There are a lot of government edicts around cars and stuff, but today, I think most people want an efficient, saying it with a gasoline car, want an efficient gasoline engine that gets high mileage, that isn't wasteful, that isn't putting out a bunch of exhaust. They like a cleaner car. So I think people, when they get rich enough, they want nicer things, and one of those nice things is clean air. So I think that happens naturally, and I think most of the clean air we've seen, the declines in emissions that we've seen in the United States, has been because of the market working, and in large part because of natural gas working, and because people want cleaner stuff. More efficient stuff. But then, my qualm with the carbon tax is, all right, so you tax everyone in the United States for their use of carbon, fine. I think that just makes us less competitive on the global scale. And yeah, maybe you convince every other country on earth to put up a similar carbon tax. I don't believe that actually happens. I think that's a fairy tale land, just like my fairy tale of my libertarian energy policy. I know that doesn't ever happen, but we got to be honest that other countries are not going to follow suit here on the carbon tax. And so yes, we can go tax ourselves, and yes, I think that will reduce carbon emissions, because taxation, whenever you tax something, you get less of it. But I don't know that makes this country better. And some people just don't care, I guess, if this country's better. They care more about making sure that the earth is healthy and safe, and et cetera. And look, I get that argument, but I think we have to be prepared to say that the United States will be weaker and more, less independent with a carbon tax than without one.
Fair enough. This was funny. So Toby Rice came to our Fuse conference, and he was one of the keynote speakers, and he does a really nice job of laying out the case for natural gas and what it's done and what it could do for worldwide emissions. And after he gave his speech, he did a live CNBC interview. So he's on the stage at Fuse, hooked up, doing the interview. And the reporter that ended the conversation with Toby said, and that was Toby Rice, CEO of EQT, from what appears to be a concert in Houston, Texas. So anyway, we're like, okay, that's cool. Our energy conference is a concert. So
I think the EQT decks are spot on with the emissions decks they put out. I think those are very accurate, and how I would think about things. Of look, clean things are better. Natural gas is very clean. That's why we use more natural gas. But that's a function of the market. That's not a function of someone taxing something else. That's not a function of the government deciding to subsidize natural gas. That's a function of, we figured out how to make gas cheap. It's a far superior, in terms of its burning and emissions to coal. So we use more of it.
Well, you guys were really cool to come on.
Thank you.
Yeah.
Appreciate you having us.
Absolutely.
Yeah, always fun, Chuck. Thanks for having us.
There we go.
Thanks to the Digital Wildcatters guys.
Absolutely. So nice we didn't have Mills here to gum everything up. So. Just kidding, curmudgeon.